Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. It's the 30th of June 2023 and here are the top stories for the day. How will the new TCS regime affect you? What are the implications of the HDFC merger? Report card H1-CY23, how did the markets fare? And what is reg diving? The Finance Ministry on Wednesday said a new rule that mandated higher tax collected at source or TCS on foreign remittances won't kick in from July 1st. The increase in TCS from 5 to 20% would now be effective October 1st. More importantly, the ministry said that overseas spending using credit and debit cards as well as remittances under the liberalized remittance scheme up to Rs 7 lakh would not attract TCS. But how will this new TCS regime affect you? Debargo Sanyal has the answer.
Summers are on, and it's the perfect time for a European vacation perhaps. If you are planning to spend your holidays outside India or have relatives living abroad, the Ministry of Finance brings you good news. The government on Wednesday announced rollbacks on its proposed changes in tax collected at sources or TCS on foreign transactions, including overseas credit card spends, and postponed the higher tax burden by 3 months to October. The transactions through international credit cards when conducted overseas would not be counted as liberalized remittance scheme or LRS and hence would not be subject to TCS as was the case earlier. Moreover, any individual spending up to Rs 7 lakh annually under the LRS will not have to pay TCS. Beyond that, separate rates have been prescribed, ranging from 0.5% for education spending based on loans to 20% for several other categories. The rule will apply to all modes of payment, the Finance Ministry said in a late evening statement on Wednesday. And those of you purchasing a tour package for foreign travel using your credit cards while you are still in India, you will be covered by LRS and need to deposit 5% as TCS for a package that costs up to Rs 7 lakh and 20% beyond that. So, what does this mean for the average taxpayer?
First thing first, let's just put together what has really happened because, first it was introduced, then rolled back, then some change was announced. Firstly, credit cards are not covered under LRS. So if you're spending money abroad, on your credit cards, you will not be impacted. There's no change. There's no TCS. There's nothing connected to credit cards. Now, coming to any other situation other than overseas tour packages or, education, medical treatment, there was again 5% TCS, whatever exceeded Rs 7 lakhs. So again, that stands. There were talks of removing that 7 lakhs threshold and applying a higher rate of TCS of 20% or whatever. That is not coming into effect right now. The only thing that you're going to pay TCS on is if you're transferring money beyond Rs 7 lakhs. So the only simple advice is to ensure that if you have taxable income, if you're liable to file a tax return in India, you must do so.
The rollbacks and relaxation came in the wake of heavy criticism against the centre's move to sharply increase the TCS. Under the annual $250,000 LRS, an individual can undertake multiple spends, including investments, education, medical treatment, foreign travel, and maintenance of relatives overseas. The government has argued that several individuals are remitting money that is not in line with their disclosed levels of income, necessitating a trail of the transfers, for which TCS is levied. But tracking these transactions might get difficult now.
Well, the challenges for the government could mean tracking non-resident payment gateway systems and other forms of payments where credit card companies do not have a presence in India. The challenge for the common man could be a situation where they have to go and seek refund of these TCS because the TCS is just a withholding tax mechanism. There is another third issue, which is payments that are made through non-credit cards, like the payment gateway systems. These are non-credit card payments. So how will the government be able to make those classes of payment systems responsible is another question. I think the compliance burden in general on the payment gateway systems, credit card companies, institutions that offer these forms of facility will go up.
Experts point out, therefore, that while the relaxation on LRS will bring relief to taxpayers as well as the government when it comes to tracking credit and debit card payments, the government still has its work cut out when it comes to tracking the LRS transactions across all modes.
The long speculated merger of India's largest lender HDFC Bank and mortgage firm HDFC Limited is finalized. HDFC Chairman Deepak Parekh had said that the boards of the HDFC twins are going ahead with the merger effective July 1st. In today's special, we discuss the implications that the merger is going to have on the two entities and how it will affect the banking sector.
The merger of HDFC Limited is expected to add approximately 6 lakh crore rupees to HDFC Bank and create a balance sheet of about 18 lakh crore rupees. This will make HDFC Bank almost double the size of the ICICI Bank. In terms of market capitalization, the merger of HDFC Limited and HDFC Bank will create India's third largest entity after Reliance Industries and Tata Consultancy Services. Post the merger, shareholders of HDFC Limited will get 42 HDFC Bank shares for every 25 HDFC Limited shares. Currently, HDFC Bank has 6,300 branches across 3,000 cities and towns in the country. On the other hand, India's largest mortgage lender, HDFC Limited, has 455 offices. The merger will bring significant cross-selling opportunities for its banking products. According to HDFC Chairman Deepak Parekh, HDFC Limited offices will initially focus on the mortgage portfolio, but these centers will eventually offer other banking services too. The merger will also help the HDFC Group to build a competitive housing loan portfolio under the HDFC Bank. Currently, HDFC Bank has been receiving a fee for selling home loan products of HDFC Limited. Following the merger, HDFC Bank will aim to strengthen its home loan portfolio by leveraging its customer base of 6.8 crore.
If you see, I think, if I'm not mistaken, about there is some percentage, if not one-third, probably one-third of the balance sheet unsecured loan in HDFC Bank schemes. Now, with this, the entire home loan portfolio of HDFC being merged with HDFC Bank, so its secured loan portfolio will go up. So that's any day you ask any banker, that's good for the balance sheet. And another very, very critical aspect is this. The average maturity of home loan is far higher than any other retail loan, etc. So even though it's typically a home loan is 20-year loan, but average maturity is, you can say, about 6 years. So this will also lend to the lengthen the average maturity of the HDFC Bank's existing loan portfolio. So that's a big, big positive.
But the merger of the two entities will not come without challenges.
Are there challenges? Of course, there will be challenges before the merger. Before the merged entity, I would not like to believe that it will be value accretive from day one, because still there's a cost of SLR and CRR, and there's enough liquidity that both the banks and HDFC have garnered over the last few months. I think they will use that liquidity. And as far as private sector lending is concerned, all of us know that RBI has given the dispensation. It can be done over a period of next 3 years. So the cost of merger for the merged entity is not as much as we had thought earlier, but still they would need certain requirement of liquidity to meet the SLR and CRR, and of course 1/3 of private sector lending. So the money which otherwise could have been used for growing the assets would need to be used for the regulatory purposes. So these are the challenges. They are not unsurmountable. and the merged entity is well equipped to meet these challenges.
Prashant K. Bhosle of Kuhu believes, as a systemically important bank, the merger will have a ripple effect in the entire banking sector.
It will impact positively other banks getting excited. Consumer will benefit because if the cost comes down and the expansion happens much larger because the number of branches and distribution that it will now have access to, I think it will increase competition and good healthy competition in the market, and which will benefit customers and banks. And other banks will have to start now thinking hard of innovating and how to provide better customers, better product and better process and all of those things.
According to experts, the merger is likely to benefit both the merging entities, shareholders, and especially customers, as there will be increased competition in the housing loan portfolio. For the banking sector too, the merger will be an impetus as it can increase the competition. However, with HDFC Bank and SBI taking up almost 50% of the deposits and mortgages, other banks may experience a squeeze in deposits in the medium term.
Both the HDFC boards will meet on June 30th, which would also be the last board meeting of HDFC, and its shares will go off market from July 13th. Meanwhile, market action in the first half of the calendar year 2023 was triggered by moderation in domestic inflation, steady interest rates, return of foreign investors, and some support from domestic institutions. Against this backdrop, benchmark indices notched fresh lifetime highs during these first 6 months of 2023. So which sectors emerged as the leaders and the laggards in the first half of this calendar year? And will the momentum continue in the second half as well? Lovi Shadarad explores.
Despite a weak start for bourses in 2023 due to higher rates and Adani Hindenburg saga, renewed interests from foreign investors helped markets pick up pace from March onwards. The S&P BSE Sensex rallied over 11% from March lows, sprinting to an all-time high of 64,050 on Wednesday, June 28. The NSE Nifty too hit a record high of 19,011. Overall, benchmark indices gained up to 5% so far this year. Subsequently, sectors like BSE Auto, Realty and FMCG led the charge in the first half of the calendar year 2023, rising up to 20%. On the other hand, BSE Metal, Power, Oil and Gas indices were the most hit as they skid up to 11% during this period. So, what triggered these sectors to become the top leaders and laggards of the first half of calendar year 2023?
Realty index has done well in the current calendar year as offtake of properties has been buoyant and inventories have fallen. Despite high interest rates, this has been due to higher affordability, low price hikes and need for larger houses. Auto index has done well this year as the backlog of orders of the past few years due to supply constraints is now getting reduced, and the capex cycle, rising incomes and healthy adoption of EVs has led to robust numbers by the auto companies. Oil and gas, metals and power indices have underperformed this year so far. This is due to the global impact of commodity prices which have been soft.
As we step into the second half of calendar year 2023, analysts expect the Realty Index to perform well in this half, while IT and metal indices may see some pressure.
Realty segment also is showing signs of recovery and the momentum is likely to sustain. Given the economic slowdown in US and the cut in tech spends, the IT sector will continue to remain under pressure. But for long-term investors, IT is fairly valued now. The metal segment is not showing any signs of recovery. Metal prices are likely to remain subdued for the rest of calendar year 23.
On Friday, June 30, markets will resume trading sessions after a holiday. Global cues, oil prices, and rupee movement will continue to guide domestic equities.
He's making plans for an early retirement. Business Standard.
Below the boundless blue expanses lies the centuries-old wreckage of RMS Titanic, surrounded by mesmerizing oceanic flora and fauna. At least that's what the tourists traveling in OceanGate's Titan submersible must have been looking forward to. While the expedition met with a catastrophic end, it has brought to light how wreck diving is developing as a popular segment of the global underwater tourism market. Debargo Sanyal takes a deep dive to decode what is wreck diving.
Underwater worlds surely appear like wonderscapes. It gives a feeling that everything has slowed down around you. Add to this a shipwreck, and you might as well be traveling in a time capsule. The second Titanic tragedy, where OceanGate's Titan submersible imploded during its voyage to the wreck of Titanic, brought to light the growing popularity of wreck tourism within the underwater diving community. Wreck diving is a recreational deep-sea expedition to explore shipwrecks, aircrafts, and other man-made structures. While every dive poses a unique array of hazards, it's in the bucket list of an increasing number of deep-pocket adventure enthusiasts around the world. In fact, wreck diving is emerging as a fast-growing segment of the global underwater diving tourism market, which was valued at $3.93 billion in 2022. The market is expected to grow at a compound annual growth rate of 8.4% to reach a valuation of $5.2 billion by the end of 2028, according to a report by Market Data Forecast. While OceanGate's Titanic expedition is fairly new, there are numerous other sites that offer divers a unique opportunity to experience the ocean as a museum. Then there's the SS Thistlegorm, Sharm el-Sheikh, Egypt, often hailed as one of the best wreck dives in the world. This 420-foot British transport system sank in 1941 following a German air attack. At advanced recreational depths, the Thistlegorm is a fantastic glimpse into history. But one of the most accessible wrecks is the American warship USAT Liberty, with its upper section just 10 feet underwater. In 1942, it was torpedoed by the Japanese off the coast of Bali. Then there is SS President Coolidge, originally built as a luxury cruise liner. It came as a troop ship during World War II. In 1942, she was struck by friendly mines and sank. Other popular dive wreck sites include the Fujikawa Maru, that's stranded 30 feet below the surface of Chuuk Lagoon at the Federated States of Micronesia, and the Hilma Hooker at Bonaire, the Caribbean Netherlands. So what are the risks? The most common is entanglement. This can occur when tourists get entangled in fishing nets, ensnared on ship structures while circumnavigating the wreck. A reliable dive knife can go a long way in solving this issue. Another risk is that of silt out. A silt out can become dangerous if a diver's nearby exit is blocked from view. Limited visibility causes confusion, and often the diver progresses further into the wreck accidentally.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
That's all for today. Catch the next episode of The Morning Show tomorrow. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.